And so is this here just another fake out, or are we going to reverse here in Ethereum? Looking at the data, looking at the simulation of buying and selling Ethereum according to a strategy, it looks like currently Ethereum is going to. Hi, in this video we're going to discuss again trading according to moving averages, one of my favorite strategies with Ethereum or with crypto in general. And over here we've got the Ethereum price with the moving average. Now historically I've always used the 23 and the 39-day moving average because those work the best. However, that backtest, that simulation of buying and selling Ethereum had been done quite a while back. I think it was in around June of last year. So now I've done an update of that backtest. I've checked what's actually the best moving average taking all of Ethereum's data into account. And this is the result what historically worked the best. So the idea is that you want to be outside of the market when the price is below the moving average, and you want to be in the market whenever the price is above the moving average. So let's just take one of those over here. So that's the idea. You want to avoid those large crashes, but you still want to be in the market when we are somewhat bullish. Doing that backtest, doing that simulation of buying and selling, we can see when prices tend to decline, and this was more than a 90% decline over here, right? This was during the crypto winter when Ethereum really lost a lot of its value. During that period, we've got quite a few extended windows where we are simply in cash, where this portfolio line here is simply just horizontal. Then once we turn around, once we get bullish, we follow the price movements again, thus in the end outperforming just buying and holding Ethereum, right? Buying and holding is in white, the portfolio line is in green. Now there are two moving averages that work pretty much the same way, that pretty much create the same kind of end result. And what are those two moving averages? It's the 22 and 34 day simple moving average. So what we see over here is the result of 52 backtests. So that's the duration of the moving average. What kind of duration should we actually take when we trade according to that strategy, right? Should we take, say, the 35 day? Should we take the 22 day? Whatever kind of duration we take here for that moving average in the end decides when exactly we are going to buy and when exactly are we going to sell. We want to know what's actually historically the best. And when we look at this just recent updated backtest, it's not anymore the 23 and 39 day moving average, it's the 22 and 34 day moving average. So that's the new kind of approach that I will be using. I will look at the 22 and 34 day. So when we plot this on this interactive chart and we look at the recent price action, we can see we are currently above both of those moving averages, indicating that we might potentially go up from here, right? But we also see a problem with this approach. Even though historically this worked pretty well for both of those moving averages, we still see sometimes we get fake outs. Sometimes the price just shoots above, we buy for expensive, then the price goes down again, we sell for low. So buy high, sell low. That's not necessarily what we want, right? These sideways trading ranges that happen very close to the moving averages are not very nice for the strategy, right? The capital line here tends to decline. Now, one way to potentially approach this is maybe let's not take the simple moving average, right? That's currently what we're using. When you go to tradingview.com and you click over here on this icon, you can actually add two different types of moving averages. You can add the simple moving average or you can add the exponential moving average. Now, what's the difference? The simple moving average just takes the average price for whatever your duration you define over here, right? In this case, 22 days. It takes the average price and it just plots the average price here on the point today. The exponential moving average is slightly different. It takes more weight to the recent data, less weight to the prices that happened in the past. So it's slightly different. It's an alternative approach that a lot of people use. Thus, I've also backtested this. So the reason why I see two lines over here is because we've not just the simple moving average that we backtested here, we've also backtested the exponential moving average. SMA, simple moving average, EMA, exponential moving average. So the EMA is in yellow. So again, on the y-axis, we've got the annualized return of the backtest, of the simulation of buying and selling. And on the x-axis, we've got the duration in days for the moving average. By the way, for this backtest, I have not included any trading fees. I've also not included any potential DeFi returns that you could do, right? You could just put your money into some stablecoin farming and make 20% per annum. I just assumed we are completely in cash, completely in stablecoins, and we don't pay any trading fees. Basically just to simplify the backtest, just to see what kind of signals give at least the best direction, historically speaking. And so comparing this, right, we can see the results of the exponential moving average. They tend to be more consistent. We can take any kind of duration from, say, the 15-day EMA all the way to the 51-day, no problem at all. But they do tend, at least for the top performers, they do tend to underperform the SMAs somewhat. If you wanted to take an EMA, your best shot would be the 30-day EMA, right? The 30-day exponential moving average. But I prefer to keep it simple. I also like to get the best kind of historical returns as an approximation what could potentially work best in the future. Now, as I said, this strategy is by no means perfect, right? It gives us a hint of where we might potentially go, but sometimes we get wrong signals over here. And there's also some kind of ambiguity. What should we actually do when both of those moving averages work comparatively well, when we only cross one of those moving averages, right? What should we do, say, on the 20th of November? Should we already buy? Should we wait until we cross both? And then even if we crossed both, we might just go back down again, right? So again, buy high, sell low. So there is a way to optimize this further. And I will show you the idea behind this, but I can't show the perfect settings here. And I will show you later why. So this is again the historical trading return according to using the 22-day simple moving average for Ethereum, right? We don't lose as much when times are bearish. We tend to gain similar returns when times are bullish, maybe not as much, but still risk versus reward is better. We in the end outperform quite a bit. By the way, this is a logarithmic scale, right? So each line over here represents a 10x. So what might not look like a lot over here, in the end is quite a big difference, right? If you would trade according to that strategy, you would now be way beyond 10,000 in Ethereum, right? Had you started trading with 1 unit of Ethereum at the beginning. So this is a multiple X difference. Now there's a way to do this even better. You can actually get this kind of a return. Also by using the 22-day moving average. Note that when times are bullish, we are not exiting the market at all. We are not going to underperform just buying and holding. And note that when times are bearish, we continue to stay outside of the market. So here we had a slight decline because sometimes we got these fake outs as we have recently, thus leading to slight losses, not as much as just buying and holding, but still slight losses. That's not the case for this adjusted strategy. Now let me show you what the adjustment is and what I've exactly done here. So the idea is that you want to prevent trading according to fake outs. So let's again just take one of the moving averages, the 22. This worked slightly better. You want to prevent trading according to the fake outs. So what that means is you might want to trade according to a certain buffer, right? So maybe you don't yet exit when we only go down below this moving average by, in this case, let's zoom in here. In this case, 1.8%, right? Maybe you want to wait until we at least cross by 3% or 5% or 10 or maybe even 20%, right? You want to have some kind of a buffer to stay outside of the market and not have these fake out trades. So that's the sell side buffer, the cash buffer. And then the same goes for the positive movements, right? When we are in a bull market, you don't want to sell too quickly. And that's then in the end how we can get even more outperformance. This is more than a 10x outperformance over this entire time. So see how we are simply just way more calm. We trade way less when times are bearish and we are much more in the market. We really follow the positive momentum when times are bullish. That's simply because we have some kind of a buffer. So this is what this means in practice. Let's say we've got our price and it fluctuates somewhat, right? It goes up and down, and then we've got our moving average, which sometimes might cross slightly, sometimes maybe a bit more pronounced. And so we would then have a buffer zone around this. So let's maybe draw this buffer zone here in red, we would say we need a minimum movement above a certain buffer zone, a minimum movement beyond a certain buffer zone to actually start doing something. And so let's say in our case, we are now here above the moving average, right? And we also get above this upper buffer. So we would continue to be in the market, follow the price movements. Let's say here we are still above the buffer. We continue the price movements. Now here we even fall below the lower buffer. So now we would be outside of the market and we wait with buying until we again hit this upper buffer. So that's then where we would continue buying again and follow the price movements, something like that, right? And so we wouldn't always be selling low and buying high. We would rather wait until we get a decisive movement above or below the buffer. Now, the big question is, what's the ideal buffer over here, right? How much should we wait? Should we sell once we fall maybe 10% below the simple moving average? Should we wait until we fall 15%? Should we just have a buffer of 1 or 2%? What's the optimal buffer over here? What's the buffer that allows for this kind of an outperformance? And this is now the big cliffhanger for the pitch for the premium membership here at thebitcoinstrategy.com. Link is in the video description. Over here, we've got a video just recently released, moving average buffer backtest results. So over here, we've got a video describing how much should you actually wait with buying or selling when using the simple moving average that worked historically the best for Ethereum, which is the 22-day. So when you want to improve this kind of a performance to this kind of a performance, you have to be somewhat more reluctant in buying and selling. You have to give the signals some kind of a slack, and the amount of slack you have to give, the percentage points that the price has to be above or below that 22-day simple moving average is explained over here. We've also got tutorials on how to actually build such a backtest. So that's over here in tutorials. We've also got a statistics library where you can download all of those Excel sheets. So those tests, those calculations have simply been done with Microsoft Excel. If you want to do something yourself, feel free to download this over here. Of course, there's also a premium chat. So if you're looking for another backtest, feel free to simply message me over here and I will do my best to accommodate. I do a backtest almost every single day here for the premium members. If you're looking at Ethereum, focus on the 22 and 34-day moving average, but be careful, don't always trade them. Give this some kind of slack. If you're currently outside of the market and you just get a little bit of a signal, then it's probably not yet strong enough. Wait for a decisive movement. Using a buffer is probably just one possible approach. You could also combine those moving averages with other approaches. There are a lot of different strategies. You could use crosses of moving averages. You could use completely different indicators over here. So you're really just limited by your imagination. I'm going to backtest more approaches. If you're just looking at Ethereum and if you're just looking at moving averages, don't just take randomly the 7-day or the 14-day or anything like this. Better use something that worked best historically, at least if you assume that the market structure is somewhat consistent, that the psychology of the market participant hasn't changed too much. Then that's probably your best bet, 22 and 34. If you plot this yourself, make sure in TradingView that you've selected here the daily tick size, right? So you want to click over here and make sure that you select 1 day. Only then the moving averages length here actually refer to that correct time frame. As an additional point, you probably want to watch the backtest of the relative strength index. So when you enter RSI, you get the relative strength index over here. That's an oscillator which can also be used for potential buying and selling. I've done a backtest on that also for Ethereum. So that's the next video. You shouldn't miss that either. This is very valuable content. See you in the next video and thanks for watching this one. Bye bye.